Budget 2023 offered many things, but the biggest of all for the common man were the changes in the personal taxation rules. Interestingly, most of the changes that the finance minister announced were to do with the new tax regime. In fact, 4 out of the 5 now announcements that were to do with personal taxation were actually for the new tax regime. But this has also given rise to many questions. Why is the government moving towards the new tax regime? Because there was definitely a clear nudge towards the new tax regime, considering the announcements. Then how will it affect the savings and investment pattern of people going forward once the new tax regime kind of becomes the one that you may have to choose? And but a very key question that remains right now is, since the old regime is still there, it's still optional, it's still an option, how does one choose between new and old regime? So I'm Nidhi Sinha, Outlook Money editor, and I hope that you will get the answers to all those questions and more. And welcome to this webinar series, which is part of the Investor Education and Awareness Initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money. To answer all your questions and discuss Budget 2023, we have with us today 3 panelists. I would like to first introduce and welcome Mr. K.S. Rao, who's Head of Investor Education and Distribution Development at Aditya Birla AMC. Mr. Rao has been striving to take financial literacy and investor education across the country. We also have with us Mr. Amit Trivedi, who's an author, speaker, blogger, and trainer, and has more than 2 decades of experience in the capital markets. He's authored a number of books, such as Riding the Roller Coaster. Our third panelist today is Kiran Telan, a SEBI-registered investment advisor and a certified financial planner, who incidentally has also co-authored a book with Mr. Trivedi called Moneywise: Perspectives for Women. So welcome to this webinar series, all of you.
Thank you.
So getting into the discussion right away, because everybody has these questions on their minds. So Mr. Rao, I would ask you first that what are the main takeaways you think were there in this budget for investors?
Thank you so much, Nidhi. I'm sorry for my bad throat. Please do excuse. And it's always glad to be part of this webinar. And I'm sure on the budget we may be discussing a little late, but it could provide some insights which so far we would not have seen and or read, or investor can go back and today's audience can understand what the budget implication is. And this is the 5th budget from Honorable Finance Minister, and I look at this budget on a very pragmatic note, and it is a budget, as she started with saying, it is the first budget of the Amrit Kal. Means, it's paving the way for the next 25 years, how it can shape it up for India. And what is shaping for India is shaping for all of us. And it's a budget, she has not taken any stone unturned, and using every opportunity to empower on the macroeconomic stability as well as a strong and stable economy rather. And it's also focused on the growth and job creation, and it's a special focus on the youth. I mean, probably it's also called this budget is like a triple R, RRR. It's focused on the rail, it's focused on the road, and it's focused on the beef. And it's a huge amount of infra money which is spent on the roads. It is NHAI got allocated little over 10 lakh crores, and then 2.4 lakhs crores for the railways. And there is a good relief on income tax, but as you said, it is more towards the new tax regime. And there is another concept which I like the most is giving the Saptarshi as a concept. She took us what is the 7 priorities for the government and economy. And it could be an inclusive development and reaching to the last mile, or addressing the infrastructure and investment and unleashing the potential. And of course, the green growth and youth power. And the last one is on the financial sector. Probably if I can look at on the personal finance, probably all of us can look at parallelly on this. The last one, financial sector, but it should be the first one for us today to discuss. Effectively, I look at this budget has provided the thrust, one on the capital expenditure, and second, as earlier, when Amit was talking about, and you are telling about it, is a nudge on not only the taxation, but it is on the multiple transitions. And last but not the least, it provides a very good edge for every taxpayer today. And looking at on the personal finance, I think like the way Saptarshi, probably there are 7 changes, with 7 implications which I could see on the taxation front. The first one is on a insurance premium. If somebody is paying 5 lakh and above, I mean, then you are entitled to the money which is coming is the traditional policies which are going to be taxable, and ULIP it is about 2.5 lakhs. And REITs taxation is changed; it is going to be little less attractive. And the market linked debentures coming on par with, and it is going to lose its sheen. And then your EPF, NPS, and ELSS. We need to see how the course correction will happen and what will happen if I'm not opting to the new tax regime. Yes, I can enjoy, but how many of us, like at mutual fund industry, maybe I look at whether ELSS is good, or I need to create some parallel to nudge those investors. In spite there is no tax benefit, how you can come and lock in your money. And for the ultra HNIs, there is a capital gains about 10 crores on the it's a 54F when you are selling your house, or and then there is another one which has come was winning the online gaming feats. At this there is a there was a there is a loophole which has got plugged now. And the seventh one I look at is international investing. And international investing will come with a higher TDS now. And then whether it has become, I mean, if you are looking at liberalized remittance, I mean, whether this will deterrent for you to invest, then Indian mutual funds will have a more comfort level for the people. That way I can look at. And one area where we all need to focus is right across new income tax regime is a default tax regime. As an investor, whether you need to choose where you int, I mean, it's all in your hands. And there is a big debate which is happening in our industry is probably if you insurance and mutual fund industry, the people will always talk is like, because you have these ATC benefits, people are investing. Otherwise, how you can nudge them? Now, individual got a choice to do. What is that? Probably need of the financial advisor will go up, and need of people reading Outlook money will go up, because you are owning up yourself.
Right. So definitely the need for financial advisors will go up, because, when people are kind of choosing their own investments, they will have to kind of take expert advice if they really want to be steered in the right direction. But like Mr. Rao summed up very well on the main points of the budget. But like he said, the financial sector comes last, but we are kind of focusing on that here. And of course, the biggest debate that has come up, like I mentioned earlier also, is choosing between the new tax regime and the old tax regime. So my next question is to you, Kiran. How does one, choose between that, and what should one factor in before making that choice? Because this time, since the new tax regime, like Mr. Rao said, is the default regime, if you do not make that choice of switching to the old tax regime, you stay in the new tax regime. So it has to be a very conscious choice. Until now, the tax regime was the default one. So a lot of people, didn't take the trouble to kind of look into it, whether they wanted to switch or not. But now it is mandatory in a way for them to kind of assess the situation.
Right. So, Nidhi, what I understand is that there is this gentle nudge to go towards the new tax regime. It's been on for last couple of years. And the earlier tax regime, which was introduced as the new tax regime vis-a-vis the proposed one, was probably less beneficial. What is happening with the present budget, the proposed new regime offers definitely some benefits which investors or taxpayers can look at. I get a feeling that a lot of people will move to the new tax regime. So there are two reasons behind this. One is that obviously up to 7 lakh, I mean, there is no question. If your income is up to 7 lakhs, you are anyways not going to pay any tax. So that definitely gives an edge to people whose income is in that range to choose the move to the new tax regime. For people who have incomes of 15 lakhs, the kind of break-even point is if you have any reductions which you claim above 3,75,000. Only then, if your tax deductions that you're claiming is above 3,75,000, is when you will be better off in the old tax regime. That is, you will pay lesser tax. But if your deductions are anywhere below 3,75,000, the new tax regime will prove beneficial to you. So mota mota, if I have to say, your tax deductions, what you usually claim is under Section 80C, which is 1,50,000, which could range from your PF to your tax saving FDs to ELSS and your insurance premiums. So all that falls under 80C. So that will not be available in the new regime. Also, what will go off in the new regime is Section 80D, the benefit that you claim for your health insurance premiums paid up to 25,000. So that is 1,50,000 plus 25, that is 175. And if you have a home loan, the interest paid on the home loan is exempt. You can claim a deduction up to rupees 2 lakh.
Right.
So that basically makes it up to your 3,75,000. So if you are in that range where you're claiming anything more than this, then you will probably be better off in the old regime because your tax will come out slightly lower. But if you're in high, claiming anything below 375, then it's a straightforward case for you to move to the new regime. I get a feeling that this is something like that gas subsidy which we used to have. So the government earlier said that you please give up. They requested, it didn't happen, and then one fine day it was just taken off. So eventually, the new tax regime is something that will be, given to everybody. Old tax regime will be phased out. That's the feeling that I get. Also, I would like to add that, from a financial planning point of view, we always tell the investors, the clients that, tax benefit is an added benefit. So don't do things because you're getting a tax benefit. So I guess this new tax regime and, things like that, these that have been come up, given in this budget, is giving a fillip to that thought. So what the government has done is given you that money in terms of, a lower tax slab. So you will have more money in hand, and they have left you to decide what you want to do with your money. So as Rao sir was saying, that it's time for, investors and taxpayers to grow up and make decisions on their own, rather than the government nudging you to put money into certain specific instruments which give you a tax benefit. So if that tax instrument probably is not something which is right for you in the long run, maybe you have other options which you can look at now, because the tax benefit goes off in the new regime. So you have more freedom, but with more freedom comes more responsibility. So yes, you have to understand what suits you in the long run and accordingly choose.
Absolutely. And the other thing that the new tax regime kind of provides is less compliance. So a lot of paperwork and things like that will go down. And of course, tax saving investments is something that, like Kiran said, that we have been, financial planners and magazines like ours have been constantly saying that, don't invest just to save taxes, but look at what is really suitable to you. But broadly speaking, Mr. Trivedi, why this renewed focus on the new tax regime? Plus, if we look at it, people who are still in the old tax regime, like Kiran also said, that people who are being being able to avail deductions of 3.75 lakh, including their home loan, etc., they are really not getting anything extra. They did not get anything extra in this budget. And the same was the case last year also. So what explains the overall thinking of the government, and where is it leading to?
So thanks, Nidhi, for this question. The whole debate between old and new, I think the day the new regime was announced, I think the finance minister had made it clear that this may become the only regime over a period of time. So like Kiran was mentioning, in the gas subsidy example, it's quite possible that one day the old regime may be taken off completely. So that's quite a possibility, though nobody knows what the truth is, or I'm not privy to the inside information. So that's number one. Number two, my understanding of this particular government is they really seem to be believing in putting responsibility on the citizens. So in the old regime, certain deductions were available, but what is eligible for those deductions was decided by the acts or relevant provisions. So basically, somebody was dictating, if you do this, then you get deduction. If you do that, you get a deduction. And because of that, one of the advantages of that was that people were using those provisions to make their financial lives better. But on the downside of that is that some of the people were putting the cart before the horse, and they were looking at tax saving first and accordingly choosing the investments or insurance or other stuff, which was actually ruining their finances.
Right.
Now, so even that regime was also not completely beneficial to the people at large. Now what has happened is, if you are above a certain limit, so let's say now 7 lakhs plus that 50,000 standard deduction. So if you are earning before anything beyond that, then you can't anyway make any, or you can't claim any deductions. So that much money is in hand. Kiran beautifully explained that example of somebody earning 15 lakhs a year and setting aside 3,75,000, which actually means less money in hand to the extent of 3,75,000. Now, if you go under the new regime, that 375 is available to do whatever one wants, be it saving and investing or be it consumption. That is really a big one, because now people will have to take charge of their own lives. They will have to act responsibility. Otherwise, the mistakes could turn out to be very, very costly. But at the same time, it was a choice between being responsible under the old or being responsible under the new. So that was a real choice. Number two, the simplified procedures, as you rightly mentioned, the compliance, etc., is a lot more simplified under the new regime. And that is something commendable. If you notice, the finance minister also mentioned that in last year, I think if I remember correctly, 46% of the income tax returns were processed in 24 or 48 hours. Okay, so I think somewhere the government is also working towards lower hassles, lower compliances and stuff like that. This is one step in that direction, is my take. And if the government is anyway nudging people towards new tax regime, it's logical that they will not give any additional benefit to the old tax regime. So that's how I would put it.
Right. Yeah, I think we all agree on the point that, this the biggest pro of, the biggest benefit of this move is that people might want to invest more responsibly than they used to do earlier, not get into policies that they may not need or investments that really doesn't serve any purpose in their long-term financial life. Yes, Mr. Trivedi, you want to add something?
Just taking that line of thought further, and that actually increases the responsibility of people like us who are, media like you, or AMC like Rao sir, planners like Kiran, or educators like me. Our responsibility also goes up multifold in spreading the right message.
Right, absolutely. So coming to some of the products, so once we are past deductions, what will happen to tax-specific investment instruments like the ELSS? So this question is to you, Mr. Rao, because ELSS, in a way, it's a product that has been designed in a way to serve tax-saving needs, because there are other equity products also. There is a whole equity category that SEBI has, prescribed for mutual funds. So what will happen to products like that?
Yeah. Thanks, Nidhi. Definitely it's like, ELSS will become, it may not be very interesting for many people, those who come to the new tax regime, because you don't need to come for ELSS, you can go for any other equity scheme. But those who are in the old tax regime, still they may prefer to have this ELSS. But one thing I could see is, I'm watching this data from 1992 to till date. It was at 30,000 rupees way back in 92. Now it's a 1,50,000. But ELSS has definitely helped people to create a huge wealth. Even if you are not saving any equity, this is a little money you put it. I used to call this ELSS is a effortless saving scheme, ELSS. Then you create a wealth for it.
Right.
And now it is but government intention and whole thing is moving towards a new tax regime, which is effectively making and simplifying the personal income tax. Probably we need to look at, as Kiran and Amit said, how we can simplify our own personal finance. As earlier, Amit was telling, if I have to put that much money somewhere, it so happens, if you can see some data, we always at insurance colleagues, we keep talking that 60 to 70% of India's insurance policies were taken in the month of JFM. And
Right.
they
In fact, the recent AMFI data also, if you look at it, the number of ELSS schemes has kind of doubled in January. If you look at the data, the assets. So definitely, they were takers for specific tax saving needs. There are takers still.
Yes, absolutely. It's like this is one area where we need to have a little concern, because in Indian context, however, I can say, like, I have an urge and I need to do it. And there's an easy way money is available in my hands and it will go for spending. And getting then back to investment is very difficult. And ATC or these deductions are giving some nudge for you to save for longer, and somebody who can see the power of compounding at the end. And I was also looking at on the PPF and PF kind of it. I was looking at some of my colleagues who are going to retire in the next couple of years, which is 60 to 70% of their retirement corpus is coming from these schemes. It's a
Right.
PPF, and in such case, investor, as an individual, we got a big onus of responsibility. As I earlier said, no responsibility. Even Amit was talking about no responsibility on you, like a media, to spread how you need to take care and not to take chances. Earlier, it was forced for us. We have implemented. Now you are forced yourself, because in a country where we do not have a social security, these compulsions made you to put some money out, and this money can profitably reinvested into any equity. And there is one other way to look at. If on average people are going to save around 60,000 rupees, which is 5,000 rupees per month. This 5,000, even if you are putting for 30 years at 12%, it can give a corpus of 1.8 crores. If you are
Right.
putting in equity, and if the equity gives at 12%, that's where we need to nudge now. The biggest nudge is government is nudging towards a new tax regime, and we need to nudge the investors and ensure that you stay invested, whether ELSS is available to you or ATC is available to you.
Right, right. So wise investments, choosing what suits you is really one of the highlights of and the takeaways of the budget this time. The other thing that the budget really talked about and kind of focused was senior citizens. They got a leg up because the SCSS Senior Citizen Savings Scheme, the limit went up to 30 lakh, 15 lakh was there for a long time. And I think it was high time for that to be increased. So what were the other takeaways for senior citizens and how will they benefit from the budget, Mr. Trivedi?
I think that was a good move. And as you rightly mentioned, it was long due. But you also look at the other scheme where the limit is doubled, which is the post office monthly income scheme.
Right, right.
Now, if you look at a senior citizen, the combination of, let's say husband and wife. So now, if you do the combined limit, it is 30 plus 30 plus the post office MIS. So, and even if you consider a 7.5% return on that. Just to as a ballpark number, that's a reasonable sum of money that a retired couple can live comfortably in any part of, or rather most parts of the country. Now, having said that, does it mean that all the money should go into those schemes or not is something that investors must consider. So while increase of the limit is welcome, it was long due. But putting all the eggs in one basket, does it really make sense? Because there could be liquidity related issues. If you are in a higher income because of pension or other income, then the interest becomes taxable. And those things also need to be put together. And finally, let's also understand that the interest that one earns does not give protection against inflation. Most of the times. Right now, we are in a regime where the inflation is inched up, but not to that extent. Last year, probably the gap between the interest and the inflation was slightly better for investors. We don't know whether the schemes would continue to provide higher than inflation returns or not. And to that extent, considering the longevity, this may not remain the only choices. And one would need to diversify across. But otherwise, that's a very, very good move to increase the limits.
Yeah, so just to digress a little in a related manner, this leg up to SCSS kind of also highlights the need for regular income and to invest in a way that you get regular income after retirement. So how does one ensure regular income post-retirement? And like you mentioned, like you were mentioning that, you should not put all your eggs in one basket. So SCSS may not be the only option. And what are the other things that one can look at, and why is it so important?
So in spite of the tweaks in the personal income tax rates, the systematic withdrawal plan from mutual funds still continue to remain more tax efficient, simply
Right.
because the mutual fund is a tax deferral vehicle. So the fund does not get taxed on the income. And when you withdraw money, only that part which is capital gains is subject to whatever rate may be applicable, short-term, long-term, etc., depending on the asset categories. So to that extent, mutual funds still continue to remain a more tax efficient vehicle. So an SWP can be considered. The other advantage of SWP is the amount of flexibility that is available. You can increase the amount, decrease the amount, add more funds, take money out, lump sum investment, lump sum withdrawal. All these features are available there, and that makes it a better choice. And finally, you'll also need to keep some money which does not generate current income and allows the earning to compound, which is where this small saving schemes have one issue. The income that is paid in form of interest is considered as income for the year, and that gets added to the taxable income. So you can't really avoid taxes every year, if you are in the taxable slabs. However, if you go with an equity mutual fund or a debt mutual fund or a hybrid scheme, and if you opt for growth option, then so long as the money stays in the scheme and continues to compound, the taxes are, there's no realization of income for those years.
Right.
So it's only at the time of withdrawal that one has to do the calculation of capital gain. So to that extent, it allows your money to compound, and that compounding at a higher rate, a pre-tax rate. Plus, if the asset chosen is also, an equity kind of an asset over long period, and I'm especially mentioning about long period because a lot of times people say, I'm retired, what long term are you talking about? But we retire at, we still consider 60 as retirement, and longevity is 85, 90. So we're talking about 25, 30 years of period. If money compounds over that period at pre-tax rate in an asset class which has the potential to compound at a higher rate, then I think the later retirement years can really become very financially comfortable. So that way you need to spread money. Income is one, but you also need that growth.
Right, absolutely. And mutual funds and, in fact, ELSS may come well in use for people to invest for their retirement because it is something that needs reinvestment given the longevity, like Mr. Trivedi highlighted. But coming back to the budget and small saving schemes that we were talking about, Kiran, my next question is to you. The FM also launched this Mahila Samman Savings Scheme specifically for women. What are your views on that? Because there is one section that is saying that, the kind of limit that has been announced, which is 2 lakh right now. We are, of course, waiting for more details on that scheme, is too less. So what are your views on that?
Right, Nidhi. So as you said, the 2 lakh is too small an amount, and even the period that they've defined is just 2 years. So what will you do in 2 years with that kind of investment? So I feel it's just a token or symbolic gesture. I don't think it will really make a difference to the well-being of women or investment options that are available to them. So even if you're talking of somebody who wants to put in money for just this small period, the interest that you're earning, I'm assuming that it will be taxable. So I don't think that really will make a difference. So another aspect which there is no clarity yet is whether there will be any tax saving benefit to it, which I feel will not be there because one side you're moving people from old to the new tax regime where there are no exemptions. So it's highly unlikely that this particular scheme will get any benefit under that. So that clarity is yet to emerge. So we don't know whether there is any benefit on that. So I don't really see how this is going to help anybody in terms of an investment product that is come up newly on the horizon. And they've also mentioned that it's only available up to March 2025. So again, it's a very short-lived kind of a product, 2-year of investment tenure. Not my particular, choice of investment for any women. I would rather have that amount. If there is a 2 lakh amount available, I would rather look at, if there is a long-term goal, I would rather pick up an equity mutual fund to invest. Or if it is a shorter term goal, probably, you can also look at a debt mutual fund in that regard.
Right. So according to your needs, we come back to that point that, you have to learn investing according to your needs and suitability. The other thing that the budget kind of made a change to, which Mr. Rao mentioned earlier also, that it has removed the so-called tax arbitrage on market-linked debentures, or MLDs as we popularly call them. So, Mr. Rao, could you explain a bit about this product to our viewers and what's really changed for them? Because there's a lot of confusion about these products, because debentures is something that not a lot of retail investors get into. In fact, it is said that, that is one product that was supposed to be for the HNIs, but still, just for our viewers, if you could just explain a bit.
Yeah, this like this is like it is like you have a traditional debt instrument, debenture, which is always have a fixed coupon rate, and MLD is like it's a structured product where returns are linked to the market rated or market traded instrument, and which typically a hybrid in nature, and it has got a lower tax rate, and it is taxed at the rate of a equity earlier. Now it has gone back, and it's being added to a short-term capital gains irrespective of period of holding you have. That way, it is going to be a deterring for the people to invest. And incidentally, the amount, if I can go back and see CRISIL report last year's, which is this year's, it is little over 20,800 crores was invested in MLD this year, and outstanding debt on MLD's front is little over 1 trillion. For this is predominantly for the HNI, and now these HNIs need to look at MLDs are no more attractive. Two ways it will happen. There is an aggressive HNI, and MLDs are considered to be a safe bet too, in the sense there is an advantage in case market corrects, then you have a coupon rate is added to you, and you have given as a comfort level. Now, there will be issuers, like issuers also finding very comfortable to raise the money on this space. Now here NBFCs, and they need to look at two ways. There are two ways. One is a HNI who is taking risk-taking ability, probably continue with MLD and still you can pay, and because the kind of return is much higher, much higher than the normal debenture. And those who are not having a risk-taking ability, probably they can come back to the mutual funds, and the debt instruments still attracts at a lesser capital gains. Long-term capital gains is at 30% over a period of 20% over a period of 3 years if you are investing. That way, it can give on a post-tax basis, you get a better return if you push it to the mutual funds. Debt fixed income side. And fortunately, fixed income is placed very well at this point of time. And the one thing we need to look at is now the income arising out of this entire MLD is going to be a short-term capital gains. Means it is invariably, it is HNIs who are investing. It is being taxed over 30% plus. And one need to take that call, and then how you can look at these MLDs and what you can do. And look at LTCG and MF category is the way to look at. And the other one, if you are ability to take, and there is one possibility even, like for example, I was just looking at how much loss one may incur. It is around 1.5% to 2% on the broad spectrum. Probably this much they may increase the coupon rate. That is also a possibility. Means MLDs are not going to fully die down, but the euphoria around MLD will going to die down. So, we cannot say it's a fully arbitrary for MLDs, and but partially yes, it is true. And earlier, I'll just go back to the question what you spoke to Kiran about Mahila Saman. Probably
Right.
This budget, I always look at this budget is nudging everyone, nudging multiple category of people. Probably this is another nudge. It's not a benefit or anything. It is a nudge to women to save and invest. It's like I remember in my previous fund house when I was there, we used to have one fund called it's a Gruha Lakshmi unit plan. And we used to get a lot of women investing in it. It's nothing but it's a balanced fund, balanced fund or balanced advantage fund. And that way it is another nudge. And the previous question when Amit was talking about, for the retirees, I still look at this benefit which has come to them roughly around 70 lakhs. There are many retirees who are conservative in nature. And for them, it is not the return that matters, but the risk profile that matters. For that people, it is almost 70 lakhs of money, which is at a safest rate. Then that will allow them to take the risk on the balance money which they are investing. As he put it, it is a SWP, that. Then I also congratulate Outlook team for your new initiative, which you are going to launch from April, doing the retirement camps, because this is a country where we do not have a social security. You are going to create that nudge and that awareness. Probably, we can simplify this retirement. How you can, like everywhere we are looking at simplification, and retirement has become more complicated. How we can simplify that? When Amit was talking, I was just looking at one. If I exempt this 70 lakh rupees, so 60 lakhs plus 9 lakhs in postal and other things which are available, how you can bucket it, your 5 years money, your 5 to 10 years money, and 10 years and beyond. If somebody is retiring at 60, and if 85 is considered to be the age of life expectancy, that 15 years of money, why should it lose huge capital appreciation which can come through the equity mode? And still now they can comfortably take risk, because part of the money has gone to zero risk, zero sum game.
Right. That was very comprehensively summed up, Mr. Rao. Thank you for that. And on that note, we'll end this conversation. So the budget definitely was some symbolism, a lot of nudges for the investor to invest wisely, to choose instruments that really suit them and not just provide tax reduction, like planners like Kiran have been, and educators like Mr. Trivedi and all of you have been constantly been highlighting, and even Outlook Money for that matter. Thank you so much for being part of this session and solving some of the queries of our readers and viewers. Thanks a lot. Good day.
Thank you.
Thank you.
Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.